SpaceX is no longer just a rocket company. It is a $200 billion data platform, and Cathie Wood argues its Starlink segment alone is on a path to $1 trillion valuation.
That is the kind of alpha we are diving into today. Along with Cathie Wood, we are distilling insights from industry titans like Niles, who manages billions in tech, and macro expert Jeff Snider.
We have used advanced AI to compress over 5 hours of deep dive interviews into this single, high-octane briefing to save you time and focus on what actually moves the needle.
Get ready, because we are also uncovering why gold is becoming the world's neutral asset, and why a $1.7 trillion market might be a Hotel California trap for your capital.
Today we are looking at Cathie Wood's latest deep dive into SpaceX, and the big takeaway is that it's no longer just a rocket company. It is a $200 billion data platform.
Exactly. Cathie Wood and the ARC team argue that while everyone watches the launches, the real alpha is in Starlink's global internet dominance.
Wait, 200 billion? Is that more than most major airlines combined?
By a long shot. And Cathie believes this is just the launch pad for a much larger valuation.
While we are talking about 200 billion today, the data suggests a potential $1 trillion valuation for the Starlink segment alone.
Right. But the risk is the massive capital expenditure required to keep thousands of satellites in orbit.
So it's like a giant internet router in the sky that costs billions to maintain.
Precisely. But Cathie notes that Starlink is already hitting cash flow positive milestones. Cathie Wood's thesis centers on the fact that Starlink has surpassed 3 million subscribers, pushing revenue toward $10 billion.
That is the critical pivot. They have moved from burning cash on R&D to generating massive recurring service revenue.
Wait, 3 million people are already using space internet? I thought that was still sci-fi.
It is very real, and with a 60+% margin on services, that cash is what fuels the Mars missions.
So the internet users on Earth are basically funding the rockets to the moon.
That is actually a pretty wild business model.
According to Cathie Wood, SpaceX's competitive moat is insane. They launched 80% of all mass sent to orbit last year.
The nearest competitor is literally the entire country of China, and they aren't even close.
80%. So they basically own the highway to space now.
They don't just own it. They are the only ones with a reusable toll booth.
And that reusability drops costs by tenfold compared to traditional expendable rockets.
So everyone else is throwing away their cars after one trip, and SpaceX just refuels?
Cathie points out that by making almost everything in-house, SpaceX has driven the cost of a Falcon 9 launch down to roughly $15 million.
Compared to the industry average of 60 to 100 million, that's an unbeatable edge.
Hold on, 15 million sounds cheap for a rocket. Why isn't everyone doing this?
Because they don't have the software or the landing tech. It took SpaceX 15 years to perfect the vertical landing.
It's a software problem disguised as a hardware problem.
So it's basically a Silicon Valley company that happens to build giant metal tubes.
The real game changer Cathie highlights is Starship. It is designed to carry over 100 tons to orbit.
That's a 10 times increase over the current Falcon series. It changes the physics of what we can build in space.
Wait, 100 tons? What are we launching? A whole skyscraper?
Not quite, but think space stations, massive telescope arrays, and thousands of Starlink satellites in one go.
If Starship succeeds, the cost per kilogram drops to almost nothing.
Okay, so the moat just gets deeper and wider.
Cathie Wood is looking at a trajectory where SpaceX hits a $1 trillion valuation by 2030.
The logic is simple. If they capture even 20% of the global telecommunications market, the math gets them there.
$1 trillion? That's Apple and Amazon territory. From selling internet?
From selling global low-latency internet to every plane, ship, and rural home on Earth.
Plus the military contracts. The Starshield segment is already signing billion-dollar deals.
So it's a tech company, a telecom, and a defense contractor, all in one.
The big question is the IPO. Cathie and the team suggest a Starlink spin-off could happen in the next 18 to 24 months.
They need the predictable cash flows of Starlink to be separated from the high-risk Mars R&D for the public markets.
So I might actually be able to buy Starlink stock soon.
That's the expectation. Once the margins stabilize, it's the perfect IPO candidate.
But don't expect it to be cheap. The hype will be astronomical.
Pun intended, I assume.
To follow Cathie Wood's lead, keep an eye on Starlink's subscriber count. If it hits 5 million, the valuation model shifts again.
And watch the Starship launch cadence. If they can get to a monthly flight schedule, it's game over for the competition.
So more launches equals more money. Got it.
Exactly. The space race isn't about flags anymore. It's about balance sheets.
I'll stick to watching the cool rocket videos while you guys watch the charts.
Fair enough, but those videos are the sound of a $200 billion engine.
Today we're analyzing Matt deWolf's outlook from Trade Brigade, and he's not exactly bullish as we head into May.
Matt's looking at the historical trend. Sell in May and go away isn't just a rhyme. It's a statistical reality for many traders.
Wait, so the plan is just to stop trading for the summer and go to the beach?
Not quite, but Matt DeWolf notes that volume typically thins out, which makes the moves we do see way more volatile.
Matt DeWolf also highlights window dressing happening today as funds rebalance their books to look better for clients.
Hold on, window dressing? Like, they're literally just polishing the numbers to look profitable?
Exactly. They buy the winners and sell the losers at the last second, so the quarterly reports look clean.
And while that's happening, Matt warns that a major NASDAQ level is about to snap, which we'll break down in a moment. Matt DeWolf's core thesis is that the S&P 500 is hitting a massive ceiling at $510.
He's seeing a lot of overhead supply there. If we don't clear 510 with volume, the sell in May narrative takes over.
So 510 is the line in the sand. If we stay below that, my portfolio is in trouble.
According to Matt's analysis, yes, it's a key psychological and technical level that's been rejected before.
Matt notes that window dressing can mask the true weakness in the market today.
Right? You might see a late day rally that feels like a breakout, but it's just institutional housekeeping.
Wait, so a green day today could actually be a fake out?
That's exactly what Matt DeWolf is warning about. Don't chase the month-end noise.
Look, if the pros are just cleaning up their books, the retail traders are the ones who get caught holding the bag tomorrow. If 510 fails as resistance, Matt DeWolf is targeting a drop back to the 500 level on the SPY.
That's a significant psychological floor. A lot of institutional orders are sitting right at 500.
So we're looking at a 10-point drop. That sounds like a lot of red on the screen.
It is, but Matt thinks a reset to 500 would actually be healthy for the long-term trend.
Matt DeWolf is particularly concerned about the NASDAQ 100, or the QQ.
Tech has been the engine of this rally, but the momentum is stalling. Matt sees a series of lower highs forming.
Lower highs? That's trader speak for it's going down, right?
Bingo, it means every time the market tries to bounce, people are selling into it faster.
Honestly, if tech fails, the rest of the market doesn't have a prayer of staying afloat. We're also seeing the VIX, the fear gauge, starting to creep up in Matt's charts.
Matt DeWolf points out that institutions are buying put options at a higher rate, which usually precedes a spike in volatility.
So the big players are essentially buying insurance because they expect a crash.
Exactly. They aren't waiting for the drop, they're preparing for it now.
And when the fear index goes up, the S&P 500 usually goes down. It's a classic seesaw. Matt DeWolf predicts we could see a 3 to 5% correction in the coming weeks.
Based on the lack of buyers at the highs, a 5% drop would put us right back at that critical support Matt mentioned.
5%? My retirement account is not going to like that.
Better to be prepared for it than surprised. Matt's data shows this is a typical seasonal pattern. If we don't get a sharp drop, Matt expects a lot of choppy sideways action.
That's actually worse for most traders. The market goes nowhere but burns your options premiums to zero.
So the market is basically just going to tread water and waste everyone's time.
That's Matt's boring scenario. High volatility with zero net progress until the next Fed announcement.
It's a trader's market, not an investor's market for the next 30 days. Matt DeWolf suggests tightening your stop losses, especially in high-flying tech stocks.
If the QQQ breaks down, those gains can evaporate in 48 hours.
So I should basically set an alarm to sell if things get ugly.
Yes, but use automated stops, so you don't have to be glued to the screen.
Keep a close eye on 510 for the SPY. It's the most important level in Matt's playbook right now.
If we close above it on high volume, the sell in May thesis is dead. If we fail, look out below.
Got it. 510 is the magic number. I'm writing that one down.
Good luck out there. It's going to be a bumpy month. Gold just took a hit, but Peter Boockvar says don't be fooled by the price tag. He tells Michelle Makhoury that gold is officially becoming the world's neutral asset.
Exactly. Peter's point is that the world is looking for an escape hatch from the US dollar, and gold is the only thing with no counterparty risk.
Wait, neutral asset? Like Switzerland? Does gold just sit there and refuse to take sides?
In a way, yes. It means no government can freeze it or print more of it. It is nobody else's liability.
And while everyone's panicking over a short-term drop, Peter's looking at the massive geopolitical shift. We'll get into why the Trump trade might actually be a gold mine shortly.
Okay, so the dip is just noise, and the big picture is global financial rebellion?
Peter Boockvar highlights a massive trend. Central banks aren't just flirting with gold, they bought over 1,000 tons of it last year.
It is a diversification play. Since the US froze Russian reserves, every other country is looking at their dollar holdings and sweating.
Hold on, 1,000 tons? How many semi-trucks is that? That sounds like a lot of heavy lifting for a diversification play.
It's huge. It shows that the BRICS nations and others want an asset that can't be turned off by a politician in Washington.
So gold isn't just a commodity anymore. It's the ultimate insurance policy against the dollar.
So central banks are basically prepping for a dollar collapse. That's comforting.
Peter mentions we are in a great reset of interest rates. The days of 0% are dead and buried.
He thinks 4 to 5% is the new floor. We spent 15 years in a hall of mirrors with low rates, and now we're seeing the real cost of capital.
Wait, so my mortgage is never going back to 3%? Are you telling me I missed the boat forever?
According to Peter's analysis, yes. The era of free money was the anomaly, not this.
And that higher cost of capital puts a massive strain on the U.S. deficit, which currently sits at over $35 trillion.
35 trillion? I can't even count the zeros on that. That's a lot of interest to pay at 5%.
The math is getting scary. Peter points out that the U.S. is adding $1 trillion of debt every 100 days or so.
And when that debt rolls over at these higher rates, the interest expense starts eating the entire federal budget.
So the government is basically using one credit card to pay the interest on another credit card.
That's a perfect analogy, except their credit limit is determined by the bond market, and bond vigilantes are starting to wake up.
Which is exactly why gold looks so attractive. It's the only asset that doesn't rely on the government's ability to pay its bills.
Note to self, buy more gold, less government-backed anything.
Peter emphasizes that gold's lack of counterparty risk is its biggest selling point right now.
Right? In a world with $35.9 trillion in debt, you need an asset that isn't a government's liability.
So gold is basically the only thing that doesn't rely on a promise.
Exactly. That's why it is the ultimate neutral settlement asset for the global economy. How does the new administration affect this? Peter notes that Trump's tariffs are inherently inflationary.
Right? If you tax imports, the cost gets passed to the consumer. Peter sees inflation potentially sticking around 4% instead of hitting the Fed's 2% goal.
Wait, I thought tariffs were supposed to help us. Now you're saying my shoes are going to cost more?
In the short term, yes, it's a trade-off, but for gold, sticky inflation is like high-octane fuel.
So Peter's prediction is that the Trump trade isn't just about stocks. It's about a weaker dollar and stronger gold due to these deficits.
So inflation stays high, the dollar gets shaky, and gold wins. I'm sensing a theme here.
Where is the ceiling for gold then? Peter's looking at much higher levels if the dollar's status continues to erode.
Many analysts, following Peter's logic, see $3,000 as a very realistic target once the market realizes the Fed can't easily cut rates.
3,000? It was just 2,000 a minute ago. That's a massive jump.
It's all relative to the dollar. If the dollar buys less, it takes more of them to buy an ounce of gold. Simple math.
And with the global south moving away from dollar settlements, the demand for gold as a neutral settlement asset only goes up.
So gold is the new global currency, and the dollar is the one in the hot seat.
So what's the move? Peter Boockvar says keep your eyes glued to the 10-year Treasury yield.
If that yield climbs above 4.5%, gold might face more selling pressure in the short term. But Peter views these dips as buying opportunities.
So, wait, higher yields are bad for gold now, but good for buying later. I'm getting mixed signals.
High yields make the dollar look attractive today, but they make the government's debt unsustainable tomorrow. Peter is playing the tomorrow game.
Keep an eye on the US dollar index too. If it peaks, that's your green light for gold.
Got it. Watch the yields, ignore the noise, and wait for the neutral asset to take its throne.
Today we're diving into Jeff Snider's latest warning on the $1.7 trillion private credit market, which he's calling the Hotel California of finance.
Exactly. Jeff's analysis suggests that while institutions checked in for the high yields, they're finding out they can't actually leave now that the economy is cooling.
Wait, Hotel California? You mean the you can never leave part? Why would $1 trillion market just lock the doors?
That's the alpha here. Jeff argues that illiquidity and mark-to-model pricing are hiding a massive valuation gap that's about to snap. But while private credit is a trap, Jeff also points to a specific shift in the repo market that might be an even bigger disaster. Jeff Snider points out that private credit looks stable because it's mark-to-model rather than mark-to-market. It's basically 0% volatility by design.
Right. If you don't have to price your assets based on what someone will actually pay today, you can just pretend they're worth 100 cents on the dollar forever.
Hold on. So they just make up the price? I wish I could do that with my bank account.
It's not quite making it up, but Jeff highlights that it avoids the messy reality of the public markets where prices are dropping.
Exactly. It creates a smooth ride on paper while the actual engine is on fire.
So it's a trust me bro economy for billionaires? That sounds incredibly safe.
Jeff notes that big funds are now using redemption gates to keep cash from flowing out, often limiting withdrawals to just 2% per month.
If everyone tries to leave at once, that 5% quarterly limit means it could take years for an institution to get its money back.
Wait, 2%? If I want my money, I want it now. Are they actually allowed to just say no?
In the world of private credit Jeff is describing, absolutely, it's in the fine print. They call it managing liquidity, but it's really a cage.
So the big institutions are stuck in a room with no exits, while the building is smoking.
And here I was thinking, my gym membership was hard to cancel.
Jeff's data shows a massive refinancing cliff. Companies that borrowed at 4% are now looking at 10 to 12% interest rates.
And many of these are zombie companies that barely survived when rates were zero. Jeff argues they can't handle the math at 12%.
12%? That's like a credit card rate for a whole corporation. How do they pay that?
Most can't. Jeff points out that lenders are resorting to payment in kind, which just means they add the unpaid interest to the total debt.
So they're just digging a deeper hole and calling it an asset.
Basically, they're paying their mortgage with another mortgage. Got it.
Jeff mentions that non-accrual rates, which is just fancy talk for loans not being paid, are starting to creep up across the major private funds.
Right. Even if the models say the assets are fine, the actual cash flow from these borrowers is drying up.
Wait, so if the loans aren't being paid, why hasn't the market crashed yet?
Because of that mark-to-model trick we mentioned earlier. Jeff says they can hide the rot for a long time, but not forever.
It's a game of musical chairs where the music stopped months ago, but everyone is still dancing because they haven't looked at their feet.
That's a terrifying image. Thanks for that.
Jeff predicts a massive convergence, where private valuations will eventually have to drop 20 to 30% to match public reality.
When that happens, the institutions that thought they were in a safe asset are going to see their portfolios evaporate overnight.
30%? That's not a dip, that's a crater. When does Jeff think this hits?
He's looking at the next 12 to 18 months as the refinancing cycle forces everyone's hand.
So the Hotel California is about to have a very messy checkout season.
And the concierge is definitely not giving back the deposit.
Jeff also foresees a frantic move back into liquid treasuries once the panic starts in the private space.
Which creates its own problem. If everyone rushes for the exit at once, that 2% withdrawal limit we talked about becomes a massive bottleneck.
So first they're stuck, then they panic, then they find out the exit is a straw.
Precisely. Jeff's point is that the liquidity isn't there when you actually need it.
It's like having $1 billion in a bank account you can only access via an ATM with a $20 daily limit.
Okay, that's officially my new nightmare.
Jeff suggests watching BDC share prices. Those are publicly traded versions of these private credit funds.
If the public BDCs start trading at a massive discount to their reported book value, that's your signal that the market knows the models are wrong.
So if the public stuff starts tanking, the private stuff is already dead. It just doesn't know it yet.
Exactly. The public market is the truth teller that the private funds are trying to ignore.
Finally, keep an eye on the spread between 10-year treasuries and high-yield debt. Jeff says if this gap widens, the private credit bubble is popping.
When the risk-free rate gets too close to what these risky private loans are paying, the whole incentive for being in Hotel California disappears.
Got it. Watch the BDCs and the spreads, and maybe stay away from hotels with catchy theme songs.
Wise words. Jeff Snider's analysis shows us that in finance, if something looks too smooth to be true, it probably is. We're looking at a fascinating breakdown from Andy Schectman, the president of Miles Franklin, who sat down with Adam Taggart to discuss where gold and silver are headed.
Andy's been in the precious metals industry for over 30 years, so when he sees a pattern of de-dollarization and central bank buying, people listen.
Wait, 30 years? So he's seen every boom and bust since the 90s.
Exactly, he's seen it all, and right now he's warning that we might see one final painful dip before the biggest rally in history.
That's the alpha here. Andy expects silver could drop as low as $18 in a liquidity event before skyrocketing.
$18. That sounds like a fire sale, but we also need to talk about why the BRICS nations are making this dip inevitable.
Andy Schectman's main thesis is that a liquidity crunch could drag silver down to the $18 to $22 range.
Right? Because in a market crash, people sell what they can, not what they want. Even gold and silver get sold to cover margin calls.
Hold on. So if the stock market tanks, my safe silver also tanks?
Initially, yes, it's that temporary washout Andy mentioned to Adam Taggart.
But Andy notes that these dips are historically very brief, often just weeks or even days before the rebound.
So it's a blink and you miss it opportunity for $18 silver.
For gold, Andy sees a potential pullback to the $2,000 or $2,100 level.
That's still a pretty high floor compared to where we were a few years ago. It shows how much central bank demand has changed the game.
Wait, so even in a worst-case dip, gold stays above 2,000?
That's his view. The massive buying from countries like China and Russia is creating a hard floor.
And while we're talking gold floors, we have to look at the massive silver deficit that's lurking in the background.
Is that the part where industrial demand outstrips what we can actually mine?
Andy Schectman points out that central banks have been buying over 1,000 tons of gold annually.
And it's the highest level since 1967. They are effectively front-running the public.
1,000 tons. That's a lot of heavy lifting. Why are they suddenly so hungry for gold?
It's about de-dollarization. Andy explains that the BRICS nations want an alternative to the US dollar for trade.
Specifically, They're looking to back their trade settlements with hard assets to avoid Western sanctions.
So the big players are hoarding gold while telling us everything is fine.
Then there's the silver supply problem. Andy highlights a deficit of over 200 million ounces.
Between solar panels, electric vehicles, and electronics, industrial demand is cannibalizing the silver available for investors.
Wait, so we're literally running out of silver for tech and investing at the same time?
We are consistently using more than we produce. You can't just print more silver like you print dollars.
Andy's discussion with Adam Taggart emphasized that the COMEX and LBMA vaults are being drained of physical metal.
If the vaults go empty, doesn't the price have to explode?
A key point Andy makes is the split between the paper price on the COMEX and what you actually pay for a coin.
Right, the futures market can be manipulated by big banks, but you can't manipulate the scarcity of a physical silver eagle.
So, the price I see on Google might not be what I actually pay at a coin shop.
Exactly. Premiums rise when physical metal gets tight, regardless of what the spot price says.
Andy argues that eventually, the physical market will break the paper market entirely.
That sounds like a big short moment for the banking system.
Andy predicts we first go through a deflationary scare where everything, including metals, pulls back.
It's the classic liquidity trap. But once the Fed starts printing again to save the system, metals go vertical.
So we have to survive a crash before we get the moonshot.
That's the roadmap. Andy expects the response to the next crash to be trillions in new stimulus.
And that stimulus is what finally sends gold toward $3,000 and beyond.
Okay, so I'll keep my eyes peeled for that $18 silver dip.
Looking long term, Andy believes silver will outperform gold significantly because of the gold to silver ratio.
Currently, the ratio is around 80 to 1, meaning it takes 80 ounces of silver to buy 1 ounce of gold. Historically, it's been 15 to 1.
If that ratio narrows, silver prices have to move way faster than gold, right?
Precisely. If gold stays flat and the ratio hits 30, silver doubles. If gold goes up too, boom.
Andy calls silver the coiled spring of the commodity world.
I like the sound of coiled spring, as long as I'm not the one getting hit when it snaps.
The main takeaway from Andy Schectman is to have cash ready for that potential washout.
If silver hits $20 or less, Andy sees it as a generational buying opportunity.
So don't panic when the price drops. Buy the dip.
That's the strategy for those who believe in the long-term de-dollarization trend.
Andy also suggests keeping an eye on that 80 to 1 gold to silver ratio.
When it's high, silver is historically cheap relative to gold. It's a great time to favor silver in your portfolio.
Got it. High ratio equals buy silver, low ratio equals maybe swap for gold.
Exactly. It's a way to grow your total ounces without spending more money.
Finally, a math trick I can actually use. Thanks, Andy.
Dan Niles isn't pulling any punches. He says we are 100% in a bubble, yet he's still buying Nvidia because their revenue just exploded 262%.
It sounds crazy, but Dan Niles points out that when you have triple-digit growth, a high price tag actually makes sense in the short term.
Wait, 262%? Is that even legal? How can a company that big grow that fast?
According to the discussion with Dan Nathan and Guy Adami, it's all about the AI land grab. Everyone needs those chips right now.
The problem Dan Niles highlights is concentration. The top 10 stocks now make up about 30% of the S&P 500.
30%. So if those 10 companies have a bad day, the whole market tanks?
Exactly. Guy Adami noted, this is the highest concentration we've seen since the dot-com peak in 2000.
And while Dan Niles is still buying, he's keeping one eye on the exit because these bubbles always pop eventually.
Dan Niles makes a sharp distinction between the Magnificent Seven and the other 493 stocks.
Right, the Mag 7 earnings are actually supporting these prices, while the rest of the market is basically flatlining.
So it's not a bubble for the big guys, just everyone else.
No, Dan Niles says the big guys are the bubble because everyone is crowded into the same few trades.
It's like a crowded theater where everyone is sitting in the same row near the door.
Dan Niles mentioned that Nvidia is trading at 35 times forward earnings. Is that actually cheap for a bubble?
In Dan Niles' view, compared to Cisco in 2000, which hit over 100 times earnings, 35 looks almost reasonable.
Wait, so 35 times earnings is the cheap version of a bubble? My brain hurts.
It's all relative. Dan Nathan pointed out that as long as they beat expectations by billions every quarter, the music keeps playing.
But Niles warns that once they only beat by a little bit, the floor drops out.
The scale of investment is staggering. Dan Niles is looking at $1 trillion in potential AI infrastructure spend.
That's why he's still long on the chip makers. Big tech companies literally can't spend money fast enough on hardware.
$1 trillion. That's more than the GDP of most countries. What are they even building?
Massive data centers to train models that might eventually replace us, basically.
And Dan Niles believes we are only in the early innings of that build-out, which is why he hasn't sold everything yet.
Don't forget the Fed. Dan Niles and Guy Adamy discussed how sticky inflation means rates aren't coming down anytime soon.
I thought the Fed was supposed to cut rates this year. Everyone on the news said so.
The market hoped for 6 cuts, but Dan Niles thinks we might be lucky to get 1 or 2.
Exactly. Higher rates usually kill high-growth tech stocks, but so far, AI hype is winning the tug of war.
So it's AI versus the Fed. That's like Godzilla versus King Kong.
So when does this end? Dan Niles predicts a 10% correction once investors start asking if these AI tools are actually making money.
Right now, companies are buying chips, but they aren't all seeing a return on investment yet. That's the show me the money moment.
So we're just waiting for the CFOs to realize they spent $1 billion on a chatbot that tells jokes.
Pretty much. Dan Niles thinks that realization hits later this year or early next.
Niles is staying with Nvidia until that revenue growth slows down significantly, specifically if it drops toward 50%.
50% is still huge. Most companies would kill for 5%.
In a bubble, 50% is the new zero. If growth slows, the valuation multiple has to contract.
That's Dan Niles' signal to get out. Until then, he's riding the momentum.
Dan Niles suggests keeping a very close eye on the 10-year Treasury yield.
If that yield spikes above 4.5%, Dan Niles believes tech stocks are in for a world of hurt.
So if interest rates go up, my tech fund goes down? Got it. Watching the bonds now.
It's the ultimate gravity for stock prices.
Finally, Dan Niles and the risk reversal team talked about looking for value outside the Mag 7.
Wait, does value tech even exist? Isn't that an oxymoron?
It refers to companies with actual earnings and lower multiples that haven't participated in the AI mania yet.
Basically, Dan Niles is saying, enjoy the bubble, but don't be the last one holding the bag.
Note to self, find the exit sign before the party stops.
To kick things off, Cathie Wood argues that SpaceX isn't just a rocket company anymore. It's a data platform poised for $1 trillion valuation, driven by Starlink.
Exactly. She believes that the data capabilities of Starlink could transform industries by providing connectivity to previously unreachable areas.
Wait, so a satellite internet service is worth that much? How does that even work?
Well, think about it. Broadband access changes everything from education to healthcare. Next up, Dan Niles brings a cautionary viewpoint. He thinks we're caught in a tug-of-war between genuine growth and speculative euphoria.
Right, Niles underscores that tech stocks, while booming, might be overvalued relative to actual growth.
So, if I get a tech stock now, am I really just riding a wave that could crash?
In simpler terms, yes, invest carefully or you could be in for a fall. Moving on to Jeff Snider, he argues that the perceived stability in financial markets is misleading.
Snider posits that underlying economic pressures could trigger significant market corrections.
So it's like thinking you're on solid ground when it's actually quicksand? Yikes.
Exactly. Snider warns that this false sense of security could have serious consequences. It's noteworthy that all 3 guests agree the tech sector is at a make-or-break point.
Yes, they see this as a crossroads where innovation meets valuation risks. It's a critical moment.
So whether it's about Starlink or tech stocks, the buzz around tech could be a double-edged sword.
Right. One wrong move could lead to drastic shifts. Cathie and Dan both highlight how broader economic conditions weigh heavily on tech valuations.
Absolutely. Cathie talks about the growth potential, while Dan remains cautious about the surrounding market environment.
So they're both looking at the same data, but coming at it from very different angles, right?
Exactly. It's fascinating how the same trends can lead to different conclusions. A significant point of contention arises between Cathie and Dan. Cathie thinks the market is justified in its valuations, while Dan warns of a potential bubble.
Right. Cathie argues that innovation in tech like Starlink supports current valuations.
But Dan positions himself on the more cautious side. He sees the euphoria as a worrying sign, right?
Exactly. The optimism is great, but it can lead to a harsh reality check.
Jeff Snider and Cathie Wood clash over the idea of financial stability. Cathie is optimistic about growth, while Jeff sees instability ahead.
Yes, Cathie focuses on the transformative potential of innovations.
So it's a classic case of looking through rose-colored glasses versus seeing the storm clouds. Huh?
Right. And understanding this tension gives viewers a fuller picture of the market landscape. If you enjoyed this discussion and want more insights like these, don't forget to hit that like button.
Subscribe to stay updated with our top expert analyses, bringing you all the latest financial intel.
Seriously, this rounded perspective on market trends is gold. I'm absolutely subscribing.
Thanks for watching, and we'll catch you in our next video, where insight meets strategy.